Welcome back. Chapters 1 through 8 review, part 2. We're going to start with some journal entries. Please pull out your course pack, print it out, and let's try to do this on your own. I'll give you the solutions, but what really adds value to any sort of exercise we do on these videos is for you to stop the slideshow and come up with a journal entry on your own. So the very first journal entry in any business usually is that the stockholders invest money in the company. The exception to that would be if the company is able to get a loan, but most new companies are unable to get loans, so they start with owner's investment. So all these journal entries are going to be from the point of view of the company. So stockholders invest $35,000 in a company. We don't care about the stockholders' books. We care about the company's books. So what happened at the company? They just received $35,000 in cash. So let's follow the rules of debit and credit for asset accounts. If the asset account increased, that's how do we increase asset accounts? We can increase them with a debit. So we are going to increase cash. We're going to debit cash for $35,000. What do we credit? We're going to credit stockholders' equity. How do we credit that? Sorry, how do we increase stockholders' equity? I think I just answered my own question. We increase common stock with a credit. How do you remember that? Assets are on the left side of the accounting equation. Liabilities and stockholders' equity are on the right side of the accounting equation. Assets are increased with a debit. Liabilities and stockholders' equity are increased with a credit. How do you remember? Credit has an R in it, and it's on the right side of the equation. Let's do another transaction. Purchased $400 of office supplies on credit. Now, office supplies is an asset account. It's given here as an asset, so consider it one. Later on, when we use it up, we'll use office supplies expense, but we'll talk about that a little later. We purchased office supplies on credit. Now we say we purchased them, but we haven't paid for them yet. We will pay for them later. So we're going to, again, increase an asset account. That would be a debit. But we're not paying for it right away. So we're not reducing cash, which we normally would do if we paid for something in cash. And if we reduced cash, that would have to be a credit. We are going to increase a liability account. Debit, office supplies, asset account, credit, accounts payable, a liability account. We increased office supplies. We also increased accounts payable. We owe $400, we being the company. Next transaction. Purchased $6,000 worth of office equipment for $2,500 cash and the balance of $3,500 on credit. Office equipment is an asset account. It was increased by $6,000. Cash reduced. We reduce cash with a credit. But that would have made our entry be out of balance. So we also have to bring this entry into balance with that $3,500 on the credit side. Accounts payable is increased. So look at these transactions. Office equipment went up. Cash went down. Oops, let's get back there. Accounts payable went up. So the ups and the downs don't really matter. It's really about the debits and the credits and following their rules. Office equipment is increased with a debit. Accounts payable is increased with a credit. But at the end of the transaction, the debits have to equal the total of the credits. Next transaction, billed clients for consulting fees for services performed. This is a service company. Maybe they do repairs or advertising consulting, and we bill them now. $4,000. There's no cash involved yet in this transaction because we've just billed them. Is this an exchange? Yes, we performed service. The company performed service. That's where the exchange comes in. The customer now owes them something. So we're booking this from the company point of view. We're going to debit accounts receivable. That's what the that's what the customer owes us, $4,000. And we're going to credit service revenue. We're going to recognize that service has been performed, and we're allowed to do that because there has been an exchange. Paid $2,200 cash for office salaries. Now you know and I know that companies rarely pay their employees in cash, but I'm putting this here to simplify this transaction a little bit. Office salaries, what kind of account is that going to be? It's not an asset account. The employees have already worked. There's no future value in the asset. It's just an expense. So expense, normal balance for expense. Now look at the accounting equation and your printout of common accounts. Assets equals liabilities plus stockholders' equity plus revenue minus expense minus dividends. It is true that expenses are on the right side of the accounting equation, but we have that minus sign in front of it. So the normal balance for expenses are going to be the opposite. Even though they're on the right side of the equation, we're going to reverse it, which makes them a debit. So we're going to increase office salaries expense, $2,200, and we're going to decrease an asset account, cash. Received a check for $3,000 from a client in payment on account for commissions billed in a previous transaction. So we received a check for $3,000, and you can treat a check just like cash. So cash is increased. Cash is an asset account. We're going to debit cash for $3,000. Now the important thing to read here is, where did this money come from? It was commissions billed in a previous transaction. If something was billed to a customer, that means we set up an accounts receivable for that customer. If it's now been paid, we don't credit revenue anymore. We credit the accounts receivable. So cash goes up. That is the most liquid asset, cash, and accounts receivable, which is also an asset, goes down. So if you were to track this customer, you would say, a couple transactions ago, they owed us at least $3,000. Now they owe us $3,000 less. This ends part 2. Let's go on to part 3.